Hello and welcome to another edition of 9 to 5 Live. My name is Mark Williams and joining me is Francois Savary. Francois, hello.
Hello.
Thank you for joining us. Nice to see you as always. 2 weeks ago, the Fed announced a change in policy bias away from targeting 2% inflation towards supporting the economy, supporting the job market. After a period of relatively very high real interest rates, the Fed would like to engineer a soft landing. Francois, you've been saying this was going to be a soft landing for as long as I can remember, compared to a hard landing that some people were talking about. What are the components of our economy or the US economy or the global picture that can point towards you being so sure that we are going for a soft landing?
I would say that what the number we had last week were in a way represent what the numbers are telling us and why I believe that the soft landing is still a scenario that is credible for the medium term. First of all, the revision of GDP, which was revised upward for the second quarter, and mainly because of the consumption. Consumption is still high. It means that despite the fact that we know that there is a slowdown in job creation, consumer has the ability to support the economic growth. And that's very, very important because consumption is a big chunk of the GDP. And the second number, which was important, was the PCE, which is the price consumption expenditure index, because it tells you that the Fed is making it. It is bringing inflation closer to the 2% level. So for me, you have a kind of slowdown in economic activity, but not a fall in economic activity. And you have inflation decelerating, which is typically what you would call a soft landing scenario.
If we currently have latest GDP figures are still very, very high, much higher than the normal rate of growth that economists think the UK, the US economy can sustain. However, if you are expecting a slowdown in GDP, where do you think how far can that go, and how low can GDP go then?
And it means at the end of the day, soft landing is a scenario that people have in mind. We discuss a lot about it. People tend to believe that soft landing is only the phase where you decelerate. That this is only the first part of a soft landing. In a way, when you think soft landing, you need to have two elements in your head. First, we will see a deceleration, we will see lower inflation, and in a second phase, you will have a non-inflationary recovery, or what people tend to call a new economic cycle. At the end of the day, to believe in soft landing is to have in mind those two elements. As I said before, for the time being, we have some kind of certainty about the ability of the Fed to bring down inflation, slowing down activity not too much, but we don't have any certainty about when and to which extent we will see a new cycle begin in the US. That's the reason why I believe that the notion of soft landing is not something that is going to disappear from the map by the end of this year. This is something that we will have to follow through in 2025, because what will become key in the future will be the sign that inflation is really stabilized at low level and that you have some green shoots for an economic recovery in the medium term.
Therefore, if we do a touch landing, therefore we land very, very gently, and then we just rise again and take off into a new direction into the distance. What could put that wonderful Goldilocks scenario into question?
Many things, and that's my point. I think that people and the behavior of market after the kind of crash that we had end of July, early August, the behavior of market, especially the equity markets that came back very quickly, is something that I am very cautious about, because we have a lot of uncertainty. And what are those uncertainty? What can make the full soft landing scenario a risk? First of all, you have the Fed. Because, people have decided now that the Fed is going to lower interest rate quite significantly. And I think that you have no certainty on that. As we discuss it many times, over the last few weeks. I still believe that the Fed is going now to lower interest rates. It's going to be 75 basis points. And I have a lack of visibility about what the Fed is going to do in 2025. So I don't bet on a huge monetary easing cycle for the time being. I don't think it would be right. This is connected to a second element that is coming very quickly, which is November the 4th in the US, because then you will have the election in the US. Nobody knows who is going to be the next president of the United States. Nobody knows the majority in the Congress. So it means that we have no ability to define what kind of economic program will be put in place. So that's a second. And this is something that will be very important for the Fed. Because, increasing tariff, like Trump said, is going to bring inflation back in the US, to my point of view. So it will limit the ability of the Fed to act. Then you have China. Look at the numbers that came out from China lately. They are telling you that there is no recovery in China, that the real estate market is still under pressure, the real estate sector is still under pressure. It means that there is one key element for the world economy that is not growing as expected. And then you have Europe. Look at what happened in the election in Germany over the weekend. This is another uncertainty. We know that Europe has faced huge problem with growth. We don't have enough growth in Europe. But with what is happening in Germany, it means that the political background is really deteriorating quickly in Germany. So you have different factors that needs to bring you to consider, okay, don't consider that the soft landing is a done deal. The first part, yes. The second part, a lack of visibility, means that you need to be very, very cautious about the future.
There is a theory that suggests that when there's a new cycle in terms of cuts in interest rates, that actually creates worsening economic conditions because participants, Real Street or Wall Street, tend to consider that there will be further cuts, and therefore they wait for those cuts to occur before contracting credit or before purchasing. Do you agree with that this time around, for instance?
It's not something, I would not define it in terms of agreeing or disagreeing. I would define that the theory makes sense. It doesn't mean that but this is exactly my point at the end of the day. If you have a lot of uncertainties about different factors that are going to lead people to consider, okay, the soft landing is done, the slowdown is done, but the Fed is not going to act too quickly. Or the inverse, maybe they will say, oh, the Fed is going to act quickly because now we have more certainty and etc. It can really modify the speed at which you can develop the recovery. Because as you said, if people believe suddenly that the Fed needs to keep interest rate higher than expected, maybe the growth is going to come back. If they believe that they need to lower, they will wait for the lowest point of interest rates before engaging into something that's going to support the economic recovery. That's exactly my point.
This new cycle that we're expecting to start in September, it's unusual in the sense that the Fed, central banks are cutting. They're not cutting into a recession. There isn't a recession in the US. They're cutting in anticipation of a slowdown. That makes it quite different to previous cycles, doesn't it? If that's the case, how long do you think we'd have to wait before there's the gentle landing and then the gentle takeoff?
They are not, to my point of view, they are not cutting in anticipation of a slowdown. They are cutting into a slowdown. And the Fed is, in a way, what they said in Jackson Hole is, okay, now we have clear sign that the economic activity is slowing down. The labor market is slowing down. Now we have clear sign that we have been able to regain control on inflation. So for us, it's time to lower interest rates because the slowdown, and we want to limit the size of this slowdown. We want to avoid the risk of a recession. So we are not in anticipation. They are acting on facts, data dependency, and that's what they reiterate at Jackson Hole. So at the end of the day, the big question for the Fed will be at one point, and because you need to keep that in mind, people tend to consider that inflation is a fight that has been won. I'm not so sure about that in the medium term. We need to still keep in mind this inflation issue. We need not to say, okay, it's over, now it's back to 2%. Maybe it can be back to 2% for 6 months. But I still believe that medium to long term, you have still a risk of inflation making a comeback in the world economy for different reasons, and it will limit the ability of the Fed to lower interest rates.
Right, let's come to our portfolios now. Assuming, therefore, that we are going for a soft landing, how do you position your portfolio?
I still think, and we discussed many times the issue. In a soft landing scenario, clearly, you have the ability of the equity market to be interesting. But it doesn't mean necessarily the same sectors. It means that you need to be selective. It means that you need to proceed with some rotation into your portfolio. You need to, if there is a recovery looming down the road in the US, it means that more cyclical space in your equity portfolio will be warranted, less stable growth. So you need, in terms of soft landing scenario, you need to adjust regularly to see where you want to be. And if you believe that the economic recovery is not going to materialize quickly, is not going to be very strong, then it means that you need to stick with visibility and in kind of defensiveness in the sectors that you have in your portfolio. Then there is the question about bond market has had a strong run in the course of the last 6 weeks. Do you want to keep long dated bonds in your portfolio? I'm not sure that you want to be exposed to long duration bonds in your portfolio today. There is not a lot of spice and in the market anymore. So maybe it's time for you to go shorter in terms of duration in your portfolio. What does it mean for the dollar? Do you want to stick with the dollar, and do you want to sell your dollar? I still believe that the US dollar is going to weaken down the road, and that there is room for the dollar to depreciate. So that's something that you need to take into account in your portfolio.
Let's look at the week ahead now. Two very important numbers. What are you most looking forward to?
Non-farm payrolls, clearly, because this is something that people are looking very carefully after the number last month, plus the revision of that we had 10 days ago about job creation over the last year. So job creation is going to be key. I will look at the wages and the earning growth, because this is something that is very important down the road to justify monetary easing cycle. And I will look at PMIs and ISM numbers, both manufacturing and service in the US and Europe, to see where is the economy going right now.
Francois, I think that's all we've got time for. Thank you very much for joining us, and I look forward to seeing you next Monday.
Thank you. Bye bye.
Bye bye.